Welcome to the project management course. This is Upender working as an assistant professor in the Department of Civil Engineering in Andhra Engineering College. Today I would like to explain about project financing and investment criteria from this course. First of all, to know about project financing. What is meant by project financing? It is a method of funding where to invest the large amount into the large scale into the industrial projects or public services projects. It is a method of funding large scale long-term infrastructure industrial projects or the public services. It is distinct from traditional corporate finance because repayment is based not on the creditworthiness of the project sponsors, but on the expected cash flows produced by the project itself. The project assessed rate and interest are used as a collateral for the loan. When is the project finance used? When large scale projects are initiated, that time for project finance is required. It means large capital intensive projects like power plants, highways, ports, energy pipelines and telecommunication infra. These all are the large scale projects. These projects required more amount of the fund. The funding required large scale. Here the projects with predictable and stable future cash flows, often supported by long-term contracts, initiatives involving multiple stakeholders, private sponsors, governments, development banks. What are the types of the project financing? The project financing is classified into three types. They are the equity financing, debit financing and marginal financing. These types of the project financing depends on the project need, risk and potential returns, and each of its have its own benefit and considerations. In that first classification is equity financing. What is meant by equity financing? It involves selling ownership stakes in the project. This is usually done in exchange for capital. Investors who provide equity finance become part owner of the project. They share in the project profit and losses. Equity financing is riskier for investors, but it can also offer higher returns if the project is success. Here the lenders selling ownership stakes from the project owners. The exchange for the capitals. Investors who provide equity financing become part owners of the project. They share in the project profit and losses. Here the investors more risky in this project financing type. The investors facing more riskier if the project is fails. The investors get more profit if the project is success. And then second type is debit financing. It involves borrowing money to fund the project. Here to borrow money from the other organizations and to invest into the project. The borrowed money must be repaid with interest. Lenders who provide debit financing do not get ownership stakes in the project. Instead, they have a claim on the project future cash flows. Here, lenders get more profit. They get more profit from the initial investment. Here, the lenders are facing less risk compared to the equity financing. The debit finance is less risk for lenders, but it can increase the financing burden on the project, especially if the project doesn't generate expected revenues. The project doesn't. And then third one is mezzanine financing. It is a mix of debit and equity finance. It offers more flexible in repayment terms. Mezzanine finance is the combination of the debit financing and equity financing. In mezzanine financing, lenders provide loans that can be converted into equity if the loan is not repaid on time. This gives lenders the potential to become part owners of the project. Mezzanine financing can be more expensive than other types of the financing, but it can also provide a safe net for both lenders and project sponsors. And then fourth one is the large project financing. The large project finance is often used for major infrastructures, energy and construction projects. These projects require substantial capital and have long gestation periods. The large project financing is often used for the major infrastructures, energy and construction projects. The financing structure for large project is typically complex. It involves multiple parties, including project sponsors, lenders, investors, and sometimes government entities. The large project financing also requires careful risk management. This is due to the high stake involved and long-term nature of the projects. And then sources of finance. The source of the finance is any method or instrument through which an individual, company or government raises funds required for operations, investments or projects. For project finance, sources can be broadly classified into the following or the main source of the project finance. It means the source of finance means if you want to funding into the project, sometimes the lenders having insufficient funds, they get more from the sources of the finance. The sources of the finance is classified into the following main types. There, first one is ordinary shares, preference shares, debentures, bonds, term loans, deferred credits, capital investment subsidy, lease financing, unsecured loans, internal accruals, bridge loans, public deposits. These all are the sources of the financing. In that, first source is ordinary shares. And here what is meant by the ordinary shares? The ordinary shares are also called as a common shares. It represents the ownership in the company. Holders have voting rights and claim on the residual profits. It means it represents the ownership in the company. It means the lenders or the holders to buy the shares from the companies. Here the holders have the voting rights and claim on the residual profits. The main usage of the ordinary shares, the common for raising permanent capitals, no obligations to repay principals. And then second one is the preference shares. What is meant by the preference shares? The shares that provide a holder's preference in receiving dividends and assist on liquidation prior to the ordinary shareholders. What is the use of the preference shares? It offers a blend of debit and equity characteristics suitable for investors seeking steady income with moderate risk. And then third one, debentures. What is meant by the debentures? Debentures are the long-term debit instruments issued by the companies, either secured or unsecured, paying fixed interest. It is, what is the usage of the debentures? Usage of the debentures, it attractive for investors seeking safe, predictable returns, widely used for project funding. And then bonds. What is mean by the bonds? It are similar to debentures, but usually with longer maturity, may be issued by the governments, municipalities, or corporates. What is the usage of the bonds? It are used for capital intensive projects where long-term fixed rate funds are required. And then term loans. Term loans. What is meant by term loans? The loans from financial institutes for a fixed period at either fixed or floating interest rates. The uses most common for these are most common from of a project finance, especially in developing economics. And then deferred credits. Credits for purchasing equipments or goods where the payment is postponed to a future date as agreed with the suppliers. What is the usage of the debentures? Often used in a project constructions and setup stages to align costs with future cash flows. And then capital investment subsidy. What is the definition of the capital investment subsidy? It is the direct or indirect financial help from government agencies to subsidize investments in eligible projects. The use of the capital investment subsidy makes unviable projects feasible, especially for SMEs or in undeveloped regions where the government take subsidies from the agencies. Here, the next one, lease financing. What is meant by the lease financing is the acquisition of the equipment or assets of a project through leasing instead of purchasing outright. What is the usage of the lease financing? Useful for projects with high equipment cost or short asset life. And then unsecured loans. These loans given without collaterals. Unsecured loans are given without collateral, means without surety. The usage of the unsecured loans when other funding is insufficient or bridges short-term gaps. Then internal accruals, funds generated with the company from profit retained and depreciations. What is the usage of internal accruals? Often a primary source for expansion of modernization in established firms. And then bridge loans, the short-term loans used to bridge the gap until the long-term financing is secured. It is used for to support project initiations or completion when the permanent funding is delayed. And last one, public deposits. The funds rise directly from the public at attractive interest rates. The main usage is an alternative to bank borrowing, commonly used for working capital or bridging short-term needs. Bridging short-term needs. And then investment criteria. What is meant by investment criteria? Investment criteria are the standards and metrics used to evaluate whether a project is financially and strategically worth, while they ensure projects meet risk and return expectations, shaping which projects are selected for funding. What are the main investment appraisal criteria? There are four main investment appraisal criteria are there. In that first one, net present value and internal rate of returns, benefit cost ratio or profitability index, and payback periods. In that first one, net present value, It means the present value of the future project cash flows minus the initial investment. It means the initial investment is subtracted from the present value of the future cash flows to get the present value of